Yesterday we did with the biases which we left halfway. We started with overconfidence, then we went to representative bias, then we went to anchoring and adjustment, and then we stopped at availability. Availability heuristic, first is we started with the overconfidence, so we think smarter than what we actually are. Then we started with representative, is we based our decisions because of similarity. Then we had anchoring and adjustment, where we look at a number, we are fixed onto that number and we make a decision based on that. And as far as availability is concerned, we are more concerned about our decision based on the recent information available to us. How does availability bias affect investors? First is, we normally try to talk about stocks or buy stocks from what we hear in the newspapers or on our TV channels when we hear about them, or we find more and more talks by the analysts on such stocks. So it's a recent effect for us, and then we start chasing such stocks. Secondly is, investors give too much importance or they overact on the daily movements of the stock markets. The index goes down or goes up in a very big swing. Investors tend to ask themselves, what's the problem? But actually it is just a bit. If you see, even the 2008, when the markets went down drastically, if you see a last 10-year period, it was just a small blip over there. Because when you go to see everything in totality, then you will realize that things are not as bad as they seem to be. So the best part would be that avoid market tips, avoid magazines which give market tips. In fact, nowadays even TV channels have started giving market tips. I'm telling you, you can safely avoid that, because if those were really experts over there, if they would know how to make money, they will not be working on those channels. You got to understand that. Yes, what you may feel is that this guy has gone right or something is, in a bull market, any idiot or even a 5-year-old daughter, if you give her the newspapers and she'll point fingers at 10 stocks, the 10 stocks in the bull market will go up. That doesn't mean that she is smart. So in a bear market, none of these people would venture giving tips. In a bull market, everyone wants to be a portfolio manager in his own sphere of competency. Secondly, the biggest mistake in availability is to start chasing trends. Now, what is a trend? Trend is a series of events, positive or negative, and we start believing that this will just go on and on. There's something like a law of averages, and if things are going only one way, there has to be certain feedback loop which will come into play, and most of these trends are really described in newspapers, or if you remember the IT boom, this time is different. I think be very wary of these words, this time is different. Because when someone wants to talk about a trend or to sell a trend, there's always that, no, I know this cannot be the same thing. But in any bull market or a bear market, it is the irrationality of the investors which take the stocks up and up, and irrationality of those same investors will take it down. Now we come to another heuristic, is the salience heuristic. People overestimate the probability of an infrequent event occurring in the future. Saliency is actually closely associated with availability heuristic. Suppose if you have witnessed an earthquake in your vicinity, and you have been a person who has experienced that, you are more likely to be fearful about that concept for two reasons. One is because you have experienced it, so there is an availability bias with you. Another reason is earthquakes. Not many people experience earthquakes, so it's a salient effect, and you are much less likely to be moved by an earthquake if you read it in the papers. Okay, there was an earthquake in Indonesia. Oh, it's fine, because one is the availability bias is there, but you cannot be really fearful about it because it is a salient event. It is a one-off event. Two planes crash into the World Trade Center. It was a salient event. But next day, the world stops traveling. Now, when such things happen, we overreact to any information which is coming to us. In fact, the next day would have been the safest for traveling, because such things, such saliency effect don't happen every now and then. But still, when you see in the markets, a company has come out with excellent results. Now, it could be a change in fortunes, but it could be a saliency effect that in 1 year, in that one quarter, they had an extraordinary time, and that's why the profit started going up. So, in the stock markets, a saliency effect, the stock just starts climbing up. This is what happened in stocks like, I would say, during the IT boom, DSQ software, Pentafor and all, every 3 months they would come out with certain announcements. Actually, those were false announcements, but people started believing in those, and that's how those stocks, 10 rupee stocks, went up to as high as 4,000, 5,000 rupees also. Now, what are the effects of saliency? When in the markets you really come across an extremely good or a bad result, first is analyze that information intuitively. You cannot just expect that the company is going to be repeating this performance over a period of time. Most probably it happens in pharma companies. A good pharma company, when they talk about a big breakthrough in discovering a medicine or a patent expiring, markets react on all these things. Similarly, post 26/11, next day nobody went to the 5-star hotels, and it went on for another 6 months. Now terrorists, they had attacked it once, they were out. Every day they are not going to attack the terrorists. This saliency effect is so strong that till date, even in Mumbai, there is too much amount of security. Now the security could be for two reasons. One is that there is a new threat. Secondly, it could be that now that threat is looming so much over the heads of people that they are, when they witness that scene in their minds, they are always worried, okay, what if it happens again? What has happened with 2G scam? Every technology, every communication stock has just gone down. 2G scams don't happen every day. Of course, unfortunately in our country, just now we are seeing scams happening every day or being caught every day. But this is also a salience effect. That does not mean that every company which got a license would be involved in the scam. But this at the same time offers a good opportunity that a saliency heuristic is in play, and maybe we will be able to get some good valued shares which are totally downbeaten because of the sentiments have gone negative in this stock. If you remember during the IT boom, the Y2K, I don't know how many of you remember, it was the Y2K which was going to change the rules of the game. And Y2K came. Before that, every company was geared up to meet the challenges of Y2K, what's going to happen, this, that. A lot of companies started making profits because they got orders which paid them advances. Y2K came, it went off so smoothly that nobody realized. And today now, most of you even don't know what a Y2K is. Okay, now let's come to the self-attribution bias. Don't confuse the brains with the bull market. Self-attribution bias is a very important bias because it's also a cousin of overconfidence bias. Don't confuse brains with a bull market. I just told you, in a bull market, anybody can go right. And if you are right, don't consider that if you are making money into stocks, is because you made certain decisions and because of your own ability you are making money in the stocks. This is our tendency of individuals to ascribe their successes to innate aspects such as talent and foresight, while more often blaming failures to outside influences. I think this is applicable to all of us. All of us. We may differ with certain degrees, but because we have got an ego, we are always looking at thinking that we are better, and if anything wrong happens to us, the problem is out there. The two subsidiary biases which stem from these are self-enhancing bias, irrational degree of credit for the successes, and self-protecting bias is irrational denial of responsibility of the failure. This is very evident as far as our economy is concerned. After 2008, we have seen that the world economy has gone down, the stock markets are down except for the Indian markets, and the government was quick on taking credit. Well, it is because the way we are managing our finances, the way we are doing everything with our economy, that Indian markets have not gone down. Now today when they have started going down, the idea would be the FIs are leaving. So many host of reasons would come. Most of the time when something happens to the economy or not, like inflation was going up, people started blaming the agriculture minister for that. Now, agriculture minister cannot be blamed for that. But every time what we do is, we are looking at a reason to justify something which will happen or which will not happen. Okay, now take a test on a piece of paper. On the right hand side, write all your strengths, and on the left hand side, note down all your weaknesses. Take your time. I'll give you 5 minutes, 10 minutes, take your time. But be very honest to yourselves. Write down exactly what you feel about your own self. Everybody is done? Right hand side you wrote your strengths, left hand side you wrote your weaknesses. Now, all those who have the left hand side column longer, please put your hands up. Whose weaknesses are longer? 3, 4, 5. So, these people don't suffer from self-attribution test. You just completed a quiz where whenever you are asked, you always feel you are much better because you are good, overconfidence level, as well as you believe that there are no problems with you. And those people whose left hand side the weakness is much more longer, they think it's good that you at least know your weaknesses, because only if you know your weaknesses you can correct them. The most of the problem in life comes is we don't know where we are going wrong. If we know where we are going wrong, then correction is very easy. Like I said, if you cannot believe that you are making a mistake, you will never be able to learn from that. And when you start crediting yourself with all the successes because of your own efforts, what happens is you again start suffering from overconfidence bias. The world is changing. The world is not as rosy as it seems to be. It's very important that you are cautious, understand that you are nobody, then only you will be able to become somebody. But the fact is, we always believe that we are doing this, we are doing this. Ultimately, when the vagaries of life come, nothing happens. If you have a high self-attribution bias, you are susceptible to take too much of risk because you have overconfidence bias also. For traders in the markets, 2 or 3 good trades can make you feel that you are very good at trading and you could overtrade. Such people would always hear what they want to hear. As I showed you yesterday, the husband only wanted to hear what he felt like hearing. Otherwise he didn't hear anything else. Secondly, such people have very concentrated portfolios because they lay too much importance on their own abilities or on their own thinking. And if they have made money, suppose for instance, in the IT sector, then their portfolios will be too much into the IT sector because of the wrong notion that they know everything about that. Secondly, most of the corporate members or corporate employees, directors, they tend to hold their own stocks because they have too many attributes. One is the self-attribution bias, that they know that they are able to get the information they want. Secondly, even an illusion of control is there. They believe that they are controlling things. Actually, no employee in an organization can be controlling things, but he always believes that because he has knowledge of it, he is always controlling it. Good amount of research has shown that all the above hypothesis is true across all the financial markets. Periods of general prosperity are always followed by higher than expected trading volumes, which we have seen in our own markets. Higher the overconfidence and trading volumes, lower would be the average profits a person makes. And especially for you people, young and successful traders trade most and demonstrate most amount of overconfidence. The reason is that experience of life, this thing is still evading you. It's only over a period of time when you experience certain things that you start learning. Now let's go to the quizzes. Do you have the quizzes today with you? Okay. If you are not likely to seek information in the first one, or if you choose A in the second as well as the third, or if you choose C and D in the fourth, you are susceptible to self-attribution bias. Anyway, you don't need to go to the quizzes because the first quizzes let us know that who is susceptible to self-attribution bias or not. Narrate the process of self-examination. Why did you buy a stock? Where have you made money? What mistakes have you made? Have you a process in place when you choose your investments or stocks? Or when markets tank, what one must do is visit all these hypotheses. That what decision should I make? Because don't blame the outside factors. To do this, what is really required from you is, whenever you make an investment decision, write down the rationale behind making that investment decision. Secondly is, what circumstances would make you get out of that investment decision, as also been noted down. What is the process you followed when you looked at that investment? Was it a value investing process? Was it a tip? Was it something of an event which was coming? Which was the process which made you buy that stock? Write it down. And when the vagaries of the market start hitting you, you'll be very confident of what decision to make. Now we come to the illusion of control bias. I claim not to have controlled events, but confess plainly that events have controlled me. Abraham Lincoln. It is the tendency of human beings to believe that they can control or at least influence the outcomes, when in fact none of us can actually. This is most evident in casinos, where people, have you been to the casinos? Sure, if you're in Goa, you would have at least had a chance to go over there. Now, if you are playing the roulette, or if you have watched people, so many times people take up the dice in their own hands, or they are playing poker, they start thinking, and then they think, no, now it will come, they throw it like this, they throw it like this. Now you think, can it make a difference? It just doesn't matter. It's an only an illusion of control. If I want to do this, then this will happen. Some people, illusion of control can be even linked to superstitious. Because if certain people have superstition, then they get into the chair from the right hand side rather than the left hand side. They take only an odd numbered or an even numbered as their superstition is there a machine. If you have bought lottery tickets or if you have seen people buying lottery tickets, they choose which number to buy. Now, a lottery is a lottery. Whether you choose what number to buy cannot make any difference whether you are going to be a winner or not. But this is a false sense of control. You believe that you are controlling your destiny. There's this in Smallville town, there was this man who would march to the town square every day at 6 p.m. carrying a checkered flag and a trumpet in his hands. Then when he would reach an appointed place on the outskirts, he would stand there, he will wave his flag and he will blow his trumpet. A policeman was very amused. Why is he doing this? So one day he asked him that why are you doing this? He's saying, well, to see this thing, to keep the elephants away. So the policeman told, but there are no elephants in Smallville. So he says, well, that means I'm doing a great job. Now, most of the times we are doing certain things thinking that we are doing a great job, but sometimes it may not be required that you do certain things because our minds are always tuned to physics. We always believe that you do something and there is an opposite reaction to it. When we look at the workings of the stock market, you realize that for every action there is a reaction. Is totally false. What are the pitfalls for investors when they suffer from illusion of control? Trade more than what is really prudent for them. Because when you believe you control, I know of some people, they are sitting in front of the terminal and they believe to possess the ability to know whether the market will go up in the next 5 minutes, up or down. And how has that illusion of control come? Twice or thrice it could have happened that they have been able to get a good shot. So when you have this illusion of control, you tend to really trade more and more. Again, illusion of control, it could be a control of having a particular knowledge. You could have concentrated portfolios. You don't diversify your portfolios. If you are a good stock trader at a point of time, you may have all your investments only into stocks. It may not be having any real estate or anything else. You close yourself to any nudges or any professions because illusion of control makes you overconfident. So you close your mind to any possibilities from the outside world. When you talk to your brokers, you give them limit orders. Why do people give limit orders? And limit orders for what? Just 4 anners or 8 anners now. Because they believe that they understand the market and they are confident that they will get it at 4 anners, 8 anners less. Now, they may get a stock at less, but it was nothing to do with them because the market reacted, they got it. Again, illusion of control also again adds to your overconfidence. So if you really look at most of these biases, it is highly evident that they all overlap. That's why there are no strict guidelines. Okay, for this you do this, for you do this, that. Only guideline is that you have to be self-disciplined. You have to understand that you have more weaknesses than your strengths. If you do that, it's your humility will ultimately pave the way for your learning. Now, in your quiz, where did you stand? You are more susceptible for illusion of control than in case if you have chosen A in all the questions in your quiz. Because it was something to do with investments. I don't know how many had chosen A in all the questions. All the questions. Such investors fail to recognize that investing is a probabilistic activity and do not usually seek contrarian viewpoints before investing. You always got to have a contrarian viewpoint when you are making an investment decision. If you got this A, then definitely you have an illusion of control. Yes.
But isn't the flip side to this is that you just leave everything to chance?
No, I'm not. See, I'm not telling you leave everything to chance. I don't know. Today, how many of you read the news? Times of Goa, whatever this is, Times of India. Anybody read? Shit, you guys are going to be doing MBA and not reading newspapers also. Today was a Monday. It was not a Sunday. Anyway, you just pick up a copy and read the speaking tree. There what is written is, you cannot control your destiny. Whatever is going to happen is going to happen. But that does not mean that you will not make the efforts. See, today making the efforts, going through the road is most important. Because a person on the road, if he says, no, my destiny is there, and he doesn't work anything, nobody is going to feed him. But at the end of the day, if he's really worked, he has to do, we all are supposed to do our karma. That is what even the Bhagavad Gita says. That the Krishna says, don't look at the fruits of your labor. You do everything because it is your duty to do your karma. The fruits are in God's hands, you leave it to Him. So there are certain, your question was very valid, because there are certain people just believe in destiny and they don't do that. And that's why you see over a period of time, they have ruined lives. You have to go across doing something. Recognize that successful investing is a probabilistic activity. If it was not, stock markets would be very boring. Because then all the geniuses and all your computers, they'll be able to predict where the markets are going. But you cannot do that. Go back to this man with the trumpet. Does the trumpet really keep the elephants away? Does it? Listen, you saw that. Because of the trumpet, the elephants won't come. That was an illusion in their mind. Similarly is the case when you have made an investment. Are you in control of anything? There could be so many things which can happen to that stock, and that stock can go down. Now who can be blamed for that? Nobody can. Recognize and avoid circumstances that trigger susceptibility to illusion of control. You have bought a stock, done your homework, but there are a whole lot of factors. Just now as we are talking, if there is an Indo-Pak war, all your stock markets, everything will go down. Now, that doesn't mean that, oh, they think, why should I buy stocks without thinking? If something like this happens, then everything is going to go down. But no, if you have done your homework, there could be a sentimental blip. But ultimately, if you have done your homework, taken the right stocks, they will again start moving back. Always seek contrary points of view. Always be willing to ask yourself, am I going wrong? Is there something which I am missing out? Stand in the mirror every day in the morning and tell yourself that you are not as smart as you are. Slowly, slowly, once that habit draws on you, your life will improve. The quality will improve. When you are making an investment, write down, as you wrote down in your self-attribution test, what are the pros and cons? So what is the logic of investing? What is the downside risk? What can go wrong? Write that down. And when you are making a decision to switch that investment, go back to that. You have kept a link with your process of thinking. Your process of thinking is not distorted by the regular biases which can come and distort your thinking. What were the important features of the investment? The thought process which went ahead. So many times there is a thought process which you go today, and over a period of time you forget the thought process. And then there is a regret aversion when you ultimately find that had you kept with your own logic, had you kept with your own thought process, things would have been different. But what you did was you lost your way halfway and you switched to another investment, which has also done badly. That's why keeping records of your decisions are very important. Keep the rational side of the brain engaged as far as possible. That way you will have a reflective thinking approach rather than an intuitive thinking approach. Now we come to the optimism bias. Even apart from the instability due to speculation, there is the instability due to the characteristic of human nature that a large portion of our positive activities depend on spontaneous optimism rather than on a mathematical expectation. This is again the thinking of intuitive and reflective. What is optimism? Tendency of investors to adopt an inside view in lieu of the outside view that is often more appropriate when making financial decisions. Same is the case with self-attribution. An inside view is one that focuses on a current situation and reflects personal involvement, and that is the reason it is intuitive always. An outside view, however, dispassionately assesses a current situation in the context of the results obtained in the past related situations. You getting it? That when you are assessing a situation from inside, it's always, yourself is always coming in the way because you are personally getting involved in the decision. But when you take an outside view, you are putting all your ego aside. It's your humility which is, and can I assess the information, because the information has nothing to do with your personal going right or wrong. That's why if you have an outside view, you will be able to judge something much more appropriately than having an inside view. It will become clear once we go through this. Investor behavior, when you are highly over-optimistic, you tend to overload onto a stock very much. That means again you have a concentrated portfolio. Wrongly believe that they are getting market-like returns. Because what is a market-like return? Is when you look at other people, when you start, I would say, getting information from the outside, and if you have your own stocks which you have bought, just because you have bought your own stocks and just because you are over-optimistic, you are always going to believe that those stocks are always good and you are getting returns which are much better than the others. Then you will tend to read too much into the forecast which are given by different analysis because you are very optimistic about it. When you are optimistic, you cannot be looking at having any pessimistic view on it. So even if you have a contrarian view, you are more likely to avoid that. This makes people, over-optimistic people are always overconfident. Of course, over-optimism and overconfidence is more of a behavioral trait in corporate behavioral finance. In the next session, we'll start with corporate behavioral finance, and the Sun case is more about learning about how such people. I've got two cases. One is a international firm case and one is an Indian company case. So we're going to do two case studies where we will really learn about the behavioral biases that get corporates into trouble. It would be of such companies who ultimately lose outside investment opportunities and ignore the downside. In both the cases, it is absolutely evident. It's not in hindsight bias because we'll discuss the case study and then you will realize that how availability heuristic can help you even to judge other people. And the Indian case which I have made out was much before the corporate started going down. Overconfidence ultimately leads to optimism. Optimism leads to a home bias. Optimism is a result of overconfidence. It's only overly confident people tend to be overly optimistic. This also results in a home bias. What is a home bias? A desire to invest near home. A month back, if you remember, I had told you that the stock markets are really up, and if you are really looking at good value opportunities, you could invest in the US markets. If I show you the chart, those stock markets have gone up, this stock market has gone down. Now, you are just students, but I have been talking that to some of my corporate clients and everyone. But the home bias was so evident that nobody wanted to take the trouble to go and invest there. And that investing is as easy as investing in the Indian markets. There is no difference, because nowadays technology enables that you can buy a stock in the USA as smoothly as you can buy. Only thing, US markets open when you are about to sleep. That's the only difference. Otherwise the same thing. Now if you go through your quizzes in questions 1 and 3, B or C, I don't know how many of you are prone to optimism bias? Nobody is prone. Great. Then how yesterday so many of the people were optimistic that they will mark their present in the next session and get away with it. It couldn't have happened. If you all are so optimistic, then yesterday you wouldn't have got caught like this. Questions 2 and 4 and answer A tends to indicate suspectively optimism bias. Excessive optimism can make one really reckless. So ultimately, be conservative and be thrifty. Optimism can induce people to excessively favor certain class of assets. This can lead to skewed portfolios. Financial discipline is important. As I have told you, instant gratification need to be avoided. You cannot ignore the long-term benefits of the compounding, and an objective view of what you are doing is important if you take it from a good professional who has knowledge. So using a financial advisor, I think, would be very helpful. In most of our daily course, I have seen so many of my clients, they would come. If you are a chartered accountant, you believe that you know the figures, you know the numbers, so you are capable of being in the stock market. Some investors, they become so confident, so optimistic because their portfolios are going up, that they start investing on their own with half-baked knowledge. Sometimes they come and ask me, oh, I did this, I did this. I'm pretty confident that I can really buy stocks and I can do a whole lot of investment thinking. So sometimes I ask them, to cut your hair, do you go to a barber or not? Similarly, even we can cut our hair by our own selves, but we go to a profession. So is the case with investments. If you think it's just buying a stock and selling a stock, it's not that easy as it seems to be. It is the peculiar and the perpetual error of human understanding to be more moved and excited by affirmatives rather than the negatives. This is confirmation bias. It is our natural ability to convince ourselves of whatever it is that we want to believe. We always would convince what we want to believe. People attach too much importance to the information that supports their views relative to the information that runs contrary to them. We are not even willing to look at any of our contrary moves. Okay, let's do an experiment. There are 4 cards. If there is a vowel on one side of the card, then there must be an even number on the other side. Which 2 cards will you flip to test the rule? A and 2. Anybody else? Anybody with the... Yes, this is the normal answer would be A and 2. But does it test the rule? If there is a vowel on one side, then it must have an even number. Okay, so A is a vowel. It must have an even number behind. Why do you test 2 then? It has to be A and 9. Because when you pick up A, you will know that there is an even number behind it. And if you pick up 2, you will know there will be a vowel behind it. So you have not tested the rule. You have not tested the rule. So it has to be A and 9. Now why every one of you thought it is A and 2? But anyway, wherever I conduct this test, is the same thing. Is the same thing. It's because of a confirmation bias. We are looking at confirming certain things. We are not looking at the thing. If A has an even number and 2 has a vowel, you have not tested the rule. It's only when you take the odd figure 9 that you are able to come to the right conclusion. People choose 2. Why? Because you want to validate the hypothesis. You are not trying to refute refute it. Your idea should be to refute it, because you are testing whether it is true or false. But what you try to do is, consciously, mentally, you try to validate it. That's the reason everyone was choosing A and 2. Everyone is clear about it, or anybody's got questions?
Well, can you repeat what you said first? If it's a vowel, it should have an even number behind it. That doesn't mean that if it's an odd number, it can't have a vowel behind it.
See, I told you, if there's a vowel on one side, then it must have an even number behind it. Okay? On the other side, which two cards you will take to test the rule? I'm just talking, this is a rule. Which two cards you will test?
So I still take A and 2, I won't take 9, because that's not exclusive. It doesn't mean that if it's an odd number, it can't have a vowel.
No, but you see, there is a vowel over here, and behind it, there will be an even number. I'm telling you that. Behind it, it will be an even number. Now, why would you choose a vowel as well as even number? Because you are trying to test the hypothesis. But the idea is, if you choose 9, and there is no vowel behind it, then you have tested the hypothesis is true.
So I disagree, because as you said the statement first, it's like, how we learn in sets. Just because this is equal to this doesn't mean we use both.
I agree with you, but in this, no, but in this case, this is a particular case, that what is the thing, I'm not asking you to validate the hypothesis, but you have to understand how to refute it as directed. There could be a whole lot of arguments, but here it is an idea that when you are looking at this, how do we refute this? To refute that, you will have to pick up 9.
I agree that when you're testing something, you challenge it.
Yeah. Similarly, when you have this sort of biases, confirmation biases, Enron was something that all the employees, they all preferred their own company, and they knew something wrong was happening in the company, but in spite of that, the confirmation bias was so strong that they just couldn't take any decisions, because they thought, no, there is something great going to happen to this company. WorldCom was the same. In the Indian context, you had the Mafatlal group, tech boom companies like DSQ, Pentafor, all those companies, employees more get into the confirmation bias because they believe that they are overconfident about their knowledge, their illusion of control, they know that they are controlling things. So most of all these things would help them to take decisions which are against the financial interest. Investor behavior. If you have a confirmation bias, when you don't look at negative developments, you're always in the dark. When you look at screens, when they show you 52-day break and all, you tend to make decisions based on that. Now, how many of you watch your stocks on Bloomberg or NDTV or Money Control? Most of you. When you look at those stocks, a stock has gone down from 80 rupees to 20 rupees in the first 3 weeks of January. It has gone down to 20 rupees on the 27th of January. On the 28th of January, it goes up by 222 rupees. What your screen will show is this stock is 10% up. Now, how false that information is, if you really look at that. Now, today, all the instant information what we are getting is only confusing you. And especially when you are looking at the TV screens or even this thing on your TV shows, oh, this stock is up today. But if they have to say that this stock was a factor down just in this last 3 weeks, but you will only get an information. So what you are getting is availability, heuristic you are getting, which is a wrong information you are getting on the company. Now, because you have that stock, you feel it's 10% up, so it makes you happy. Employees are always concentrate on stocks of companies they work for, and ultimately people start ending up with concentrated portfolios. Okay, if you chose A in all the 3 questions, you are prone to suffer from confirmation bias. How many had not chosen A? In the first case, you are neglecting any new information is coming. That's why you are susceptible for confirmation bias. In the second case again, you are not taking information which negates your original thinking. In the last one, you are treating the price performance as the sole basis for justification. What steps can help you? Recognize your bias. In investing, don't go only on technicals but also on fundamentals. Avoid over-concentrating, especially if you work for a company. Okay, so we have completed the heuristic part of it. How many of you go through these TED Talks? 1, 2, 3. I think I would recommend that be a regular subscriber to TED Talks, because if you are in finance, don't try to look everything in finance. That will not teach you anything. You got to have different types of mental models, and TED is one of the best things you can have, because all the speakers, their speech is less than 20 minutes and they come from all walks of life. And if you want yourself to be up to date on the different types of happening, different type of thinking, and I think there's nothing better than a TED Talks.